In today's video, I wanted to take a closer look at precious metals, in particular gold, which has been on quite a strong run since November last year, as shown in this weekly chart. This comes on the back of new data showing gold purchases by central banks hitting a new 11-year high last year. You can see that from this bar chart, with the light red block increasing in size year on year in 2022, central bank demand totaled a little over 1.1 trillion. The most significant announcement of the year came towards its end when the People's Bank of China reported its first increase in gold reserves since September 2019, as you can see here. India also continued to buy gold, though at a slower pace, whilst Russia sold around 3 trillion worth of gold in January this year, which is likely to have been a trigger for the recent cooling off in price. The Central Bank of Russia did announce it would resume buying gold from the domestic producers, following international sanctions that were imposed. Effectively, Russia is swapping dollar-denominated assets for ruble-denominated assets in order to become less dependent on the US dollar. So aside from Russia, what caused the jump in central bank buying? Uncertainty with the global economy and rising inflation saw physical demand for gold rise. Now I say physical demand and not ETFs or OTC investment demand, as aggressive rate rises by the Fed would have hampered any reason to buy gold ETFs or futures contracts. The expectation that gold holds its value during economic stress and high inflation is why central banks bought the physical commodity. After all, the rate rises by the Fed have crushed many foreign currencies as a result. Just have a look at this chart comparing the US dollar in blue against the euro, sterling and Chinese yuan. Every other currency got crushed. So central banks turned to gold to protect their reserves. Now with inflation likely to cool this year, central bank buying is likely to cool off compared to last year. But that is likely to be replaced by ETF and OTC demand. Fed Chair Powell reiterated this week that the disinflationary process had begun. So without aggressive rate hikes this year from the Fed, we're likely to see gold prices benefit from a weaker dollar. You can see the inverse relationship here between the US dollar and gold prices. Gold made a low in November last year just as the dollar began to fall. If we have a technical look at gold, I mentioned a few weeks ago in my weekly note that gold is playing out an inverse head and shoulders pattern after breaking the neckline in the last week of 2022. Price did move higher as expected, hitting the first level of resistance at 1960 in the process. The upside target for the inverse head and shoulders pattern remains around 1992. Whilst we may see some short-term downside risk as price cools off, with 1836 and potentially as low as 1804 to backtest the neckline break, the bias remains to the upside with gold as the pattern remains in play. With that said, thanks for watching. Remember to hit that subscribe button so you don't miss out on future content, and I'll see you at the next one.